Hello and welcome to Closing Day. Closing Day is a local real estate show that covers everything in real estate from the very first moment you think about buying a home right up to closing day. Now there's many different things that happen between that and closing day, and we cover most of those topics on through these shows. My name is Jeff Delgrand, I'm your host, and today's topic, what we're going to cover is called a reverse mortgage. Seems like a mouthful. And reverse mortgage is, if you've never heard of it, we're going to cover it today. If you have heard of it, you may have heard of some things about it that are incorrect because they have them in the US, but in Canada, they're quite a bit different. So today with me, I have Sean Russell from HomEquity Bank, and Sean's going to help us with the details of a reverse mortgage. Sean, thank you very much for coming on the show.
Thank you, Jeff.
Now, Sean, I guess the very first question is, what is a reverse mortgage?
Well, a reverse mortgage is really a fancy name for allowing somebody to access the equity in their home.
Okay.
So that's all we're doing, through a loan facility.
Yeah.
So they need some funds, they've run out of their investments, they're healthy, they're living longer, they want or need some extra funds,
Yeah.
and we can do that by releasing some of the equity from their home.
All right. Now, can anyone do this?
No, we do work with a very specific group of individuals.
Yeah.
55 is as young as we'll go with this product,
All right.
and then there is no maximum age. But the individuals on title on the home, husband and wife, or husband or wife, need to be 55 or older.
All right, so 55 or older. So walk me through the steps of a reverse mortgage. Someone comes and let's say they watch the show and they think, I would like to get one of those. What steps would they go through?
Sure. The very first step is they would contact you, or somebody in the industry, somebody like yourself.
Thanks.
And basically, we would start the process by getting in touch with me as the BDM at HomEquity Bank.
Yep.
And the process is very simple. We're going to put an application into our system.
Yeah.
We're going to collect some data from the client, some of their identification, of course, some information about their home. We're going to take an appraisal on the property.
Right.
Because for us as a company, that is the most important factor. We need to get an actual firm value of that property so we can work the numbers from there. So that's the starting process.
Right.
And then once we get all those numbers together, we're going to put the contract or the package together for the client, and we move from there. The funding process, Jeff, just so you know, from start to finish is about 4 weeks.
Oh, that's relatively quick when you talk about a process like that. So, I mean, I love this idea because people spend their whole lives paying their mortgages off. You know, they end up with a home that's got tons of equity in it and sometimes no mortgage at all, but they don't have a lifestyle. So this is a way you're saying for them to tap into the equity. Now, how does the money come to them?
It's pretty straightforward. So at the very tail end of the process, the client is going to meet with ILA, Independent Legal Advice.
Right.
And they're going to sign off on the final documents at ILA, and then we're going to fund the money into their bank account within 48 hours from that signing.
Okay, now, is it a lump sum? How is it done?
It's really up to the client. We have two options. So the first one, and our most popular product, is our CHIP reverse mortgage, which is a lump sum product. So those are for clients that say, I need X amount of dollars today for a particular thing. Could be a new roof on their house, could be to give some money to their kids or grandkids, but they need the money today.
Okay.
The second option is a product called our Income Advantage product, and that's a hybrid. So they could take a little bit of a lump sum with that product, but also provide themselves either a monthly, quarterly, or semi-annual draw on income. So if they qualified, say, for $100,000, Jeff, they could take that out in increments. $1,000 a month until it runs out, $2,000 a quarter until it runs out, so it provides them some income options.
That's neat. It's kind of like making your house into an ATM machine.
Almost, with the benefit of no payments. So our product does not require any payments for the clients.
Really?
Correct.
Okay. So you said you can start at 55. All right. So let's say I'm 55 and I want to get a reverse mortgage on my house. What are the limitations? Do I get all my money? Do I?
That's a wonderful question. And bear in mind, with 55-year-olds, we do very little business, and I'll explain why. If you were interested, Jeff, in this product, we would look at 3 factors to start the process. We're going to look at your age, we're going to look at the location of your home, and we're going to look at the type of home.
Right.
So I'm going to start at who would qualify for our maximum of 55% loan to value. So that is our maximum. We will not lend more than 55% of the value of the home.
Okay.
In order to reach that maximum, you'd be looking at about a 75-year-old couple living somewhere in the GTA in a fully detached home. That's somebody that would qualify for our maximum of 55% loan to value.
Right.
Now, if you're dealing with a 55-year-old, you're going to go all the way down to about 18% loan to value. And the reason we go that low is we want to stay very, very conservative with this product. We don't want our clients running out of equity much later in life when they're in their 70s or 80s. We want to make sure there's enough equity still in the home that they can pass on to the beneficiaries.
Okay. Now that's, so you two, you said there's going to be equity in their home, hopefully to pass on to the beneficiaries.
Correct. That's our goal, is we want to make sure all of our clients have some equity left at the end of this process so that when they do eventually pass away, that there's something left to give to their beneficiaries. That's why we're very conservative with our loan-to-value numbers.
Okay. And what type of interest is on a mortgage like this?
Great question. We have a number of different interest rate term options that we offer, but on average, we're looking at about 5%.
Oh, really?
On average, just to sort of generalize it.
All right. So that seems fairly reasonable for what you're doing. Now, this is a home equity loan? Is that what you call it?
It is a home equity loan, correct. So we are taking equity out of the home and providing that to the clients in the form of a loan. The interest is accumulating on that, Jeff, because they're not making any payments. So if you started at $100,000, over 10 years, that $100,000 is going to grow because you're not making any payments. But what our clients often forget sometimes is that the entire value of their home is also growing at some arbitrary rate. Right. I can't really put a peg on that, but I mean, we know it's been amazing over the last 15 years, but even if you said it's growing at 2 or 3% a year, very conservative, you're still going to see that wonderful home growth, and even though your reverse mortgage is growing, there's still lots of equity left at the end of the process.
That's really good news. The TD Bank website actually has tracked home equity appreciation since the beginning of time, and the average is 6.2%.
I've seen that absolutely. So we in our illustrations we use 3% in our home growth to stay very conservative. And even with that 3%, there's still plenty of equity left after 15, 20, 25 years.
That's good news. That's good news. Now, there's all types of, what can I say, combinations of people that own homes. There's like a single individual, there's married couples, there's newly married couples, and how do you handle all those different mixes? Like how?
Really what we're looking at is when we're looking at a property and the people that are living in that property, in order to do a reverse mortgage, we're dealing with the people that are on title.
Okay.
Now again, this is a matrimonial home. So in a situation where there's a husband and wife and one of the spouses is not on title, we still have to use both ages in our application because it's a matrimonial home. So we need to ensure that both parties are over 55, whether or not they're on title or not.
Okay. Now, in one of our previous shows, we had a lawyer explain to us the difference between owning a home, tenants in common, or joint tenancy.
Joint tenants, yes.
Now, tenants in common, if just a quick description is, if one of the co-owners of the property passes away, that portion of their ownership will go to their estate. Where in a joint tenancy, if they pass away, that portion of their ownership goes to the other person. Yes. I was joking around about the fact, the way I remember it is because if it's under joint tenancy, if somebody passes away, the other person gets the joint. It's just an easy way for everybody to remember.
Right.
So is that affected at all in the way you do the home equity mortgage? Or?
It is. That's a wonderful question. So we cannot do a reverse mortgage on tenants in common. So the titling of the property must be joint tenants for us to do a reverse mortgage. Now, it's very easy to alter, and I've done this in my 2 years here at the bank. I've had some situations where we had to do this. It is a very simple process to do if the parties are willing to change the ownership. Right. A lawyer gets involved, and it's a pretty quick and simple process. But if it is tenants in common, we cannot move forward until that's changed.
Okay. Now, you said that an appraisal has to be done in the house.
Correct.
Now, what other work that needs to be done in the house? Cracked foundation, black mold in the something like that. What happens if that happens?
It doesn't happen often, but where it does happen, we give the prospects, potential clients, the individuals, the opportunity to fix up the property. So our appraisers would go out, they would note that for us, they would alert us of it, and we would come back to whomever they're working with, whether it be a bank, whether it be through a mortgage broker, whomever they're working with, we would say, this is the situation, we need to repair these items before we move forward. And oftentimes what happens is we use some of the money from the funding to cover those costs. So we can actually do the reverse mortgage and just ensure that those things are going to get done, and then we can still move forward. Okay,
so they would still apply for the reverse mortgage, they can still be approved for the reverse mortgage, and if, let's say, there was $10,000 worth of repairs need to be done to the house, what, would the lawyer hold that money aside, or?
We would simply get some estimates, and then it would be part of the contract that out of the funding, we need to pay that $10,000 to get everything up to par, and then we move forward from there. So we could indeed move forward, even if there was some things that needed to be done.
Oh, so if we have, let's say, an older couple own a home and they know some work needs to be done, this could be a way to get the...
100%. This could be a way to get the funds to do that work.
Oh, that would be brilliant. Now, do you do that very often?
Not often,
Okay.
but we definitely can do it. It's a very easy process to do.
All right. What's the most common reverse mortgage? Like, what's the reason people mainly ask for a reverse mortgage? What's their motivations?
The 2 or 3 main ones, and I'll go through them. The first one is we're working with individuals that want to alleviate the stress of debt.
Yeah.
So we do find that, unfortunately, there's some demographics that aren't playing in the favor of our seniors, where they're carrying a lot of debt into retirement and then taking on new debt into retirement. So we're dealing with folks that are very stressed about that, and
Yeah.
their cash flows don't provide the ability to cover those payments. So they want to alleviate that stress and
Yeah.
use the reverse mortgage to pay off some of those debts or all those debts. So
Right.
that's the first one. The second one, a big trend we saw last year, Jeff, was mom and dad or grandma and grandpa taking out a reverse mortgage on their home to help their kids or grandkids with their first home purchase.
Oh, okay.
I saw this in a large volume last year of reverse mortgages to help a 20-something or an early 30-something
Yeah.
young couple buy their first property.
That's excellent.
Yeah,
That's,
it's a great
Oh,
way to do it.
I can imagine after people watch the show and they get that idea from you, the phone's going to ring off the hook.
It was one of our most popular reasons last year.
And it makes sense, especially in this market.
It's so tough to buy a home right now for somebody in their, their 20, buying their first home. It's hard.
First-time home buyers need some help.
Mhm.
There's no question, and they more and more often are going to their parents and their grandparents to
They
get
sure
that
are.
help. Okay. So we've got a little bit about the process, the appraisal, putting the application, some of the reasons they can use the money. Now, one of the things I get this question all the time is, and we'll get back to this because I understand this is going to be a deep question, but the market sometimes goes up, sometimes goes down. So if somebody gets a reverse mortgage for the maximum amount and the market turns, is there not potential there for that mortgage to actually become worth more than their house? So just leaving it at that, Sean. So I don't want to, like I say, I don't want to get into that, but that's one thing I want us to keep in mind.
Sure.
I'm sure
I'm happy to answer that at a later time.
the viewers are definitely going to, I just didn't want to forget that because that's a question I get quite often.
Myself as well. I do get that.
Okay. All right. Well, we're going to take a quick break, and when we come back, we'll touch on that and a few other topics.
Great.
Okay. Thanks, Sean. Welcome back to Closing Day. I'm Jeff Delgrand, your host, and today I have with me Sean Russell from HomEquity Bank, and we're talking about reverse mortgages. Sean, we touched on a couple of topics in the first half of the show, but something I needed to ask and I forgot was, what if someone has bad credit? Are they going to qualify?
The short answer is yes, and I'll expand on that for you.
Okay, please do.
We don't decline individuals based on past credit woes or consumer proposals or past bankruptcies. We're going to work with everybody.
Right.
The only difference is they might receive less loan to value or less money
Okay.
than they would normally qualify for based on that circumstance. But we certainly will work with them.
All right. So, like for example, if someone were to come to see me because they've got debt and they're trying to clean it up, odds are, if they're coming to see me, they're really in debt and they've messed their credit up. So they could use a reverse mortgage to pay this debt off and to start to build their credit again?
They certainly can, and we see that very often.
Okay.
With our applications, we do require a credit bureau to be attached to that.
Yeah.
But again, we're not declining a file or approving a file based on that credit bureau.
Okay.
We're just looking at it because in some instances we do need income verification for the individuals, but we're certainly going to work with them through any difficult situation they have, and they can use the funds from the reverse mortgage to help their situation out.
Wow, that's great because so debt, financial stress is probably one of the biggest stresses that people have.
100%.
And this gives them a solution to a problem. So that's
it does. And just to further to that, we talked about the reasons why people use a reverse mortgage earlier, and they're not isolated. So what we often find is many of the people we work with have a little bit of debt that they want to pay off or need to pay off, but they also have other reasons as well. So they're sort of doing one or two or three things all together, and it just makes for a wonderful experience when they're all said and done.
That would be nice. Yeah, so they could potentially get a reverse mortgage to take care of debt, maybe help out a son, daughter, or a grandchild with a down payment on a home, and maybe have a portion of it for a monthly income.
All of the above. And I worked with a wonderful woman last year. She did a reverse mortgage, and she had to do a few of those things. She had to pay off some debt.
Yeah.
She needed to put a new roof on her home. She helped out some family, and she took a cruise in December of that year with her bridge club friends that she couldn't do for the previous 5 years given her circumstances. So she called me at the funding of the deal, thrilled that she was able to take this cruise with her friends.
Yeah, that's got to be rewarding being able to help people out like that.
Very nice. It is very nice.
That's great. Well, you feel like Santa Claus 365 days of the year.
There you go, yes.
Now, the other thing I was thinking, the question that comes up is there's a mortgage product. It's called a HELOC. I won't get too detailed, but basically it's part mortgage, part line of credit that people have on a house. How does that differ from a reverse mortgage?
Great question. We get this often. So HELOCs are offered by the traditional banks typically, is where you find those products. And it's just home equity line of credit.
Yes.
The main differentiator between those two products is that at the bank, to get a HELOC, you need to go through some income qualifications. Number one, which we don't need to do. So oftentimes, the seniors that we're working with won't qualify for a HELOC because of their age or lack of income, various factors, and the banks are very stringent on what they're looking for, so they might not qualify. Number two, if they do qualify, you are required to make the monthly only minimum interest payments. With our product, there are no payments required. So from a cash flow perspective, our product's very helpful for seniors that don't have the cash flow to make payments, and they don't have to qualify from the income standpoint that they would for a HELOC.
Okay. Now, that's great, especially because if they have to make payments, if they're coming to us to get a reverse mortgage to get out of debt, and then they have to start making payments again, that's just...
Well, it's troubling. And one other factor between those two products, between our reverse mortgage and the home equity line of credit, is that the HELOCs are callable, which means that at any point in time, the bank could call a client and say,
really?
we feel that we need to close down this facility, we need you to pay it back, and we're going to close it down. Now, you can imagine, if that was a $100,000 line of credit, most people would have to sell their home to pay that back. You're never going to have that fear with our product because our product is not callable. You'll never get that phone call that says you have to pay us back. So that's another big difference.
Wow, that's wonderful. Now, if someone's taking out a reverse mortgage, whether it's a lump sum or monthly payments, how's that going to affect their CPP or their income tax? I mean, I don't want to get us into this big quagmire of taxation stuff, but how's
it's a simple answer. It doesn't.
It doesn't?
It does not. It will not affect their pension income whatsoever. This is a client is simply accessing the equity from their principal residence. So there are no tax implications for one. It is tax-free dollars because the equity from your principal residence, and it will not affect in any way your pension income.
Really?
Correct.
That's ideal. Now, let's talk about the inevitable. What happens when someone passes away?
Correct. So I don't know the percentage, but in a large number of our clients,
Yes.
we get paid back when they pass away. You got to remember, Jeff, we're dealing with individuals that have said to us early in the process, we want a solution that lets us stay in our home.
Okay.
We're not dealing with individuals that want to sell their home. If they wanted to sell, they'd sell their home. So for very many emotional reasons, they want to stay in their home. They raise their kids there, their doctors around the corner, their friends, all that. They want to stay in their home. So they're going to likely age in place. They're going to stay in their home until they pass away.
Okay.
And so what happened is, if it is a couple, and let's just say the husband passes away first, the wife is going to stay in the home until she passes away. And at that point in time, their estate is going to take care of paying us back. So whatever our balance is at the time of both of their deaths, they're going to sell their home and they're going to pay us back, and whatever is remaining, they're going to pass on to their beneficiaries as they see fit in their will.
All right. So this is not, I'm bouncing around a little bit on you here, Sean, but if they have a reverse mortgage that pays them monthly, is that monthly forever?
It's monthly until what they qualify runs out. So for example, and that's a great question, if they qualified based on their loan to value of age, location of home, and type of home, let's just say they qualified for $100,000.
Okay.
They can use that income, whether it be monthly, quarterly, semi-annually. Let's just say it's $1,000 a month.
Right.
They can do the $1,000 a month until the $100,000 runs out.
Okay.
So they've qualified for $100. They're simply taking it in monthly $1,000 chunks.
I see. So just different way of cutting the
Just a different way of taking the funds that they qualify for.
Okay. Now, next question is, what if they want to sell their house?
100% can be done at any point in time.
Okay.
So just like any traditional mortgage product, we are simply a charge against title. So no different than any bank mortgage you would get. We're a charge on title. It's the client's home. It always is their home. They can sell it at any point in time they want. All that we need them to do is pay us back whatever the balance is if they sell their home. There is one other stipulation.
All right.
So, like any other traditional mortgage product, if you pay back the funds early, there are penalties when you sell your home and pay us back early. So I'll break them down for you.
Okay.
In year one, the first 12 months, it's a 5% penalty if you sell your home and pay us back.
All right.
In year two, it's 4%. In year three, it's 3%. Anytime after the third year, it's 3 months interest. So it becomes it's not onerous at all after 3 years. So I always say to folks, if you're going to sell your home in the first couple of years, you might want to reconsider us as an option. But if you want to still consider us as an option, just know there are penalties involved.
Okay. All right. That's good to know. Now, you also mentioned during the break there was 2 stipulations.
Right. We have 2 requirements of people working with us and taking out a reverse mortgage. Number 1 is that you maintain your property taxes current and up to date.
Okay.
And number 2 is you maintain your home insurance with fire insurance coverage up to date as well. So we have that right in our contract, and that's important for us because our only security, Jeff, is the home itself.
Sure.
And if property taxes aren't paid, the government could take the home. So we have to ensure that our loan on that property is up to date and current.
Okay, well that's actually, that sounds like common sense. Now, the thing we did talk about before the break we wanted to get back to is if the market turns and the house isn't worth as much as what the home equity or the reverse mortgage is, what happens?
This, I've got an answer for you, and I'm going to sort of set it up for you because it does come up often. And we are the only provider of reverse mortgages in Canada.
Right.
However, there are many providers in the U.S.
Yes.
No affiliation to us whatsoever, but the product exists in different variations in the U.S. Now, if you remember back to 2007, leading up to 2008, we had some major housing corrections in the U.S. So let's just say you had a reverse mortgage here and a house value here somewhere in the U.S.
Right.
Within 6 months, that house value came down like this. And so now the reverse mortgage was worth more than the home itself.
Yes.
In the U.S., some very negative things happen. They're calling those loans. They're foreclosing on people's homes. We don't do that in Canada. And in fact, we put it right into our final contract that goes to the independent legal advice that if that event ever happened in Canada, which it hasn't, thankfully, and I hope it doesn't ever happen, but if it did in the future happen, we would take and incur any losses on that. We would never ask for somebody for more money than what they owe us. So if their house went down like this, we'll take the loss on that.
Really? So they're not going to lose their house?
They're not going to lose their house. They're not going to be foreclosed on. They're not going to have anything happen. And if they passed away with their house being valued here and the reverse mortgage here, so the reverse mortgage is more than the value of the house, we would take the loss on that. Their estate does not owe us anything more than.
Really?
Yes, correct.
That's really, really comforting.
It is comforting for our clients, yes.
Yeah, because that's a question I'm sure that comes up all the time.
I get it often. Yeah, I do get it often.
Yeah. Now, can someone use a reverse mortgage when they buy a house?
Yes, there are circumstances where we can, and I'll give you an example. I had, actually it was believe it or not, a couple in Orangeville that were looking to relocate from Orangeville to downtown Toronto because their kids and grandkids were living downtown Toronto. So they were looking to sell their Orangeville home, which was valued at about $500,000, and to purchase a condominium in downtown Toronto. Now you can probably guess that the condominium they wanted in downtown Toronto was worth more than their home in Orangeville. That's just the way the housing market is.
That's right, yes.
They still wanted to do that move. But what we did for them, we did a reverse mortgage on their new property, their new condo in Toronto. So we can indeed do what you just described, which we kind of consider a purchase, but it's a relocation to a new property.
Okay, so, I mean, that's good news for real estate agents because then they can use reverse mortgages to help with a purchase.
Absolutely.
And for someone who's moving from a house of lesser value into a property of higher value, like you said,
which is happening often now, yes.
Then those people don't have to worry about a mortgage payment.
Well, that's just it. So they're thinking the stress of, oh my goodness, how are we going to afford this condo that's $150,000 more than our home in Orangeville?
Yeah.
The reverse mortgage can help with that.
That's amazing. I mean, most people don't think that they can move from Orangeville to Toronto. They always think people are moving from Toronto to Orangeville, which is, by the way, it's a good move. If you're anywhere in Dufferin County, Bolton, anywhere around here, I think you should probably move from Toronto and come down and visit us.
There you go.
So I'd like the way you put all this together for us. You've been able to simplify this topic.
Thank you.
You've made me feel a lot more comfortable about reverse mortgages. So basically, reverse mortgages, they're not going to lose their home. There's no payments they have to make. Correct. They get their money today. That's wonderful.
There's no tax implications. It's,
that's
equity in your
great.
principal residence. Yeah.
That's amazing. Sean, I want to thank you very much for coming on the show.
My pleasure.
And I want to thank everyone there for viewing and coming and participating with us. And Sean, I'm blown away. Thank you very much.
Thank you very much, Jeff. I appreciate it.
Okay.
Thank you so much.